Imagine this for a moment. Somewhere in America right now, a person you've never heard of is quietly earning more in a single day than most people earn in a decade, and they're doing it without private jets, without flashy cars, without social media fame, and without ever telling anyone how rich they really are. That thought should instantly trigger curiosity, but more importantly, it should raise a serious question in your mind. If extreme wealth can exist without noise, attention, or luck, what do those people understand about money that most of us were never taught? Invisible billionaires are not myths, and they are not unicorns created by viral startups or lottery-level luck. They are the result of a very specific way of thinking about money, time, risk, and systems, and understanding that mindset is far more useful for your financial life than chasing any headline success story. These people don't win money, they build money. They don't bet on trends, they own boring but essential parts of the economy. And most importantly, they structure their lives around cash flow, durability, and long-term advantage rather than short-term excitement. Most people grow up believing wealth looks a certain way. Big houses, luxury brands, expensive vacations, visible success. That picture is reinforced daily by advertising, social media, and entertainment, but invisible billionaires operate in the opposite direction. They understand something fundamental early on: money is a tool, not a signal. Flashing wealth attracts attention, expectations, and risk, while quiet wealth attracts freedom and control. Instead of spending energy proving they are successful, they focus on staying successful. This mindset alone changes everything. When you stop trying to look rich, you suddenly have more capital to actually become rich. That shift is uncomfortable for many people because it goes against social validation. But it's the foundation of real financial stability. Invisible billionaires often start by mastering boring fundamentals. They pay close attention to cash flow long before they care about net worth. Cash flow is the oxygen of any financial system. It's not how much money you have on paper, but how reliably money moves into your life without constant effort. Most people chase income by trading time for money, working harder, taking on more hours, or climbing ladders that depend on someone else's approval. Invisible billionaires focus instead on building income systems. These systems can be businesses' ownership stakes, licensing models, or infrastructure that generate steady revenue regardless of daily involvement. The key idea is separation, separating income from personal labor. Once income is no longer tied directly to hours work, scalability becomes possible. Another critical difference is how they think about risk. Most people misunderstand risk as volatility or fear losing money. Invisible billionaires see risk as fragility. A system that breaks easily under pressure is risky, even if it looks profitable. A system that survives downturns, inflation, and market shifts is valuable, even if it grows slowly. This is why many invisible billionaires own companies that do not sound exciting. Waste management, logistics, insurance services, industrial components, software infrastructure, agricultural supply chains. These businesses are not trendy, but they are essential. When the economy slows down, people still need trash collected, goods transported, data processed, and food produced. Stability beats excitement when building long-term wealth. They also understand inflation at a deeper level than most people. Inflation is not just rising prices, it is the silent tax on idle money. Keeping large amounts of cash without a purpose slowly erodes purchasing power. Invisible billionaires do not let money sit still unless it serves a strategic role, like liquidity for opportunities or protection against uncertainty. Instead, they allocate capital into assets that either grow with inflation or benefit from it. This doesn't mean reckless investing. It means thoughtful ownership, businesses that can raise prices, assets that generate income, and systems that adapt to economic changes. They are not obsessed with timing the market, they are focused on positioning within it. Debt is another area where their thinking differs sharply from the average person. Most people experience debt as pressure. Credit cards, car loans, student loans, mortgages that stretch budgets thin. Invisible billionaires view debt as a tool, not a lifestyle. They distinguish clearly between productive debt and destructive debt. Productive debt is tied to assets that generate cash flow or long-term value greater than the cost of borrowing. Destructive debt finances consumption that loses value while charging interest. This distinction shapes every financial decision they make. They avoid debt that traps them into fixed obligations without upside, and they are disciplined about leverage. When they borrow, it's usually at favorable terms, backed by assets and structured to amplify returns rather than stress. Saving also looks different at higher levels of financial understanding. For most people, saving is about restriction, cutting expenses, and delaying gratification. Invisible billionaires see saving as optional once systems are in place. Early on, they save aggressively because saving creates flexibility and reduces dependence. But over time, saving alone becomes insufficient. You cannot out-save structural economic forces like inflation and rising costs. That's why they transition from saving money to owning productive assets. The purpose of saving is not accumulation for its own sake, but deployment into systems that work harder than personal effort ever could. Investing for invisible billionaires is not about chasing returns. It's about ownership and control. They prefer private investments, direct ownership, or concentrated positions where they understand the underlying business deeply. Public markets are useful, but they are not the primary engine of their wealth. This is an important lesson for everyday investors. You don't need insider access to think like this, but you do need patience and understanding. Index funds, for example, are a practical tool for most people because they represent broad ownership of productive companies. They are boring, consistent, and aligned with long-term growth. The key is consistency, not brilliance. Invisible billionaires win not because they predict the future perfectly, but because they stay invested long enough for compounding to work. Compounding is often described mathematically, but its real power is psychological. It rewards discipline and punishes impatience. Invisible billionaires understand that time is the most valuable input in any financial system. They structure their lives to give compounding as much time as possible. This means starting early when possible, staying invested during downturns, and avoiding unnecessary disruptions. They don't panic during market crashes because they expect volatility. In fact, downturns are often opportunities to acquire assets at better prices. Fear-driven selling is one of the most expensive mistakes average investors make, and invisible billionaires profit from that fear by being prepared when others are not. Another overlooked factor is lifestyle design. Invisible billionaires intentionally keep their personal expenses far below what they could afford. This is not about deprivation, it's about leverage. Low fixed costs create resilience. When your lifestyle requires a constant high income to sustain, you become fragile. Job loss, business downturns, or health issues can quickly turn into financial crises. By keeping expenses manageable, invisible billionaires gain optionality. They can walk away from bad deals, wait for better opportunities, and take calculated risks without fear of immediate collapse. This freedom is more valuable than any luxury purchase. They also understand the digital economy differently. While many people chase online trends, side hustles, and viral income ideas, invisible billionaires focus on infrastructure rather than attention. Attention is volatile and exhausting. Infrastructure is durable. This could mean owning software tools, platforms, data systems, or services that other businesses rely on. In the modern economy, invisible wealth often comes from enabling others to operate more efficiently. You don't need to be famous if your system is essential. This mindset applies at every scale. Even a small business owner can think this way by asking, what problem do I solve consistently, and how can I make that solution repeatable and scalable? Modern work opportunities are also viewed differently through this lens. Invisible billionaires do not see careers as identities, they see them as phases. Early work is often about skill acquisition, not income maximization. Learning how systems work, how money moves, how value is created, and how organizations operate is far more valuable long-term than chasing the highest starting salary. Skills compound just like capital. Someone who understands operations, finance, negotiation, and strategy can adapt across industries. This adaptability is a hidden asset that protects against economic shifts and technological disruption. Technology itself is not worshipped, but understood. Invisible billionaires know that technology amplifies existing advantages. It does not replace fundamentals. A bad business with technology is still a bad business. A good business with technology becomes more efficient and scalable. This grounded perspective prevents them from overpaying for hype or chasing every new innovation. They wait for clarity, real adoption, and sustainable economics before committing capital. This patience often looks like missed opportunity to outsiders, but over time it proves to be wisdom. Another crucial aspect is how they think about control versus growth. Many visible success stories prioritize rapid growth at the expense of control. Venture-funded companies, aggressive expansion, and constant scaling can create impressive valuations, but they also introduce dependency and risk. Invisible billionaires often prefer slower growth with higher control. Owning a smaller piece of a massive, fragile system is less attractive to them than owning a large piece of a stable, profitable one. Control allows them to make long-term decisions without pressure from external investors or quarterly expectations. Tax awareness also plays a role, but not in the way people often imagine. Invisible billionaires are not obsessed with loopholes or avoidance schemes. They focus on structure. How income is earned matters as much as how much is earned. Business income, capital gains, and reinvested profits are treated differently than wages. By structuring income through ownership rather than labor, they naturally reduce tax friction over time. This is not about evasion, it's about alignment with how the system is designed. Understanding these rules early allows for smarter decisions later. One of the most powerful but least discussed traits of invisible billionaires is emotional regulation. Money amplifies personality. If someone is impulsive, insecure, or fearful, more money will magnify those traits. Invisible billionaires cultivate calm decision-making. They do not react emotionally to market noise, social comparison, or short-term setbacks. This emotional stability allows them to think clearly when others panic. It also helps them avoid lifestyle inflation driven by insecurity rather than genuine enjoyment. They are also selective about information. While the average person consumes endless financial news, opinions, and predictions, invisible billionaires filter aggressively. Too much information creates confusion, not clarity. They focus on signals, not noise. Long-term trends, structural changes, and fundamental data matter more than daily headlines. This disciplined information diet protects them from emotional decision-making and keeps their strategy consistent. For the average person watching this, the goal is not to become a billionaire or replicate someone else's path. The real value lies in adopting the principles that make invisible wealth possible. Start by shifting focus from income to systems, from appearance to substance, from short-term gains to long-term resilience. Build financial habits that prioritize cash flow, low fixed costs, and consistent investing. Learn how money works in the real world, not how it's portrayed online. Understand that wealth is often quiet, slow, and built during periods when no one is watching. The modern economy rewards those who think in terms of ownership, adaptability, and durability. Jobs will change, technologies will evolve, and markets will fluctuate, but the core principles remain stable. Invisible billionaires are not special because they are smarter or luckier. They are different because they are patient, disciplined, and focused on fundamentals. They accept that building wealth is not exciting most of the time. It is repetitive, strategic, and often invisible. But over years and decades, that quiet consistency compounds into extraordinary results. If there is one takeaway to hold on to, it is this: real financial power comes from reducing dependence and increasing optionality. The more choices you have, the less visible your wealth needs to be. The less you need to prove, the more control you gain. Invisible billionaires understand that the ultimate luxury is not consumption, but independence. And that independence is built not through shortcuts, but through systems that quietly work every single day, whether anyone is watching or not.